Navigating the mortgage process is a critical step for anyone looking to secure a home loan, as it lays the foundation for future financial stability and the successful purchase of a home. At its core, this process involves the steps and decisions involved in applying for and obtaining a mortgage, including understanding interest rates, loan types, credit requirements, and the overall financial responsibilities tied to home ownership. Successfully navigating this process is crucial because it can significantly impact long-term financial health, affecting everything from monthly budgets to overall credit scores. The significance of understanding this process relates directly to the pitfalls that can arise when one is not adequately prepared. For instance, failing to understand different mortgage types, such as fixed rate versus adjustable rate mortgages, can lead to financial strain down the line. A fixed-rate mortgage provides stability with consistent monthly payments, which can be essential for budgeting, whereas an adjustable-rate mortgage might offer lower initial rates but could result in financial shock if rates increase. Another common pitfall is not shopping around for the best mortgage rates and terms, which can lead to paying thousands of dollars more over the life of the loan. By emphasizing the importance of navigating the mortgage process, prospective borrowers can avoid these unnecessary expenses and challenges. Real-world applications of understanding the mortgage process are numerous. For example, a first-time homebuyer who takes the time to research and compare loan options may find a lender offering lower fees or more favorable terms, reducing long-term costs. Alternatively, a borrower with a strong understanding of their credit report and how it impacts their mortgage application can take steps to improve their credit score before applying, thus securing a better interest rate. Opinions supporting the importance of navigating the mortgage process often highlight the empowerment that comes from being an informed borrower. Experts frequently stress that knowledge in this area can protect consumers from predatory lending practices and help them make decisions that align with their financial goals. However, there are challenges and alternative viewpoints in this area. Some argue that the complexity of the mortgage process itself is a barrier, particularly for those with limited financial literacy. Others suggest that systemic issues, such as disparities in lending practices, can complicate the process further for marginalized groups. This point connects to other aspects of avoiding common pitfalls when applying for a mortgage by underscoring the need for education and preparation. By mastering the mortgage process, prospective borrowers can make informed decisions, proactively address challenges, and ultimately secure the most favorable mortgage terms available to them. Understanding mortgage basics is crucial when navigating the often complex process of applying for a mortgage. Essentially, this involves grasping the different types of mortgages available and the terms associated with them. Mortgages can vary significantly, with some common types including fixed-rate mortgages, adjustable-rate mortgages, ARMs, interest-only loans, and government-backed loans like FHA and VA loans. Terms refer to the various components of a mortgage agreement, such as the interest rate, loan duration, and repayment schedule. Understanding these elements can empower applicants to make informed decisions, potentially saving thousands in the long run. This knowledge is significant because it directly influences the main topic of avoiding common pitfalls when applying for a mortgage. By comprehending the basics, prospective homebuyers can choose the right type of mortgage that aligns with their financial situation and future plans, thus sidestepping costly mistakes. For instance, selecting a fixed-rate mortgage might be beneficial for those planning to stay long-term in their homes, providing stability with constant payments. Conversely, for those anticipating moving or refinancing in a few years, an adjustable-rate mortgage might offer lower initial rates appealingly. Real-world examples highlight these concepts. A young couple might opt for a fixed-rate mortgage, ensuring their payment remains the same throughout the loan term, helping with long-term budgeting. In contrast, another buyer, planning to relocate within 5 years, might choose an ARM to capitalize on low initial rates, accepting the risk of future rate adjustments to save money up front. Several financial experts endorse the idea of thoroughly understanding mortgage basics. They argue this knowledge not only assists in selecting suitable mortgage options, but also enhances negotiating power with lenders, potentially leading to more favorable terms. However, challenges exist. The mortgage landscape can be confusing, with constantly changing interest rates and a myriad of loan options. Missteps could result in borrowers selecting inappropriate products, leading to unnecessary financial strain. There are also alternative viewpoints promoting the use of mortgage brokers to navigate these complexities, which some prefer for personalized advice despite potential additional costs. Understanding mortgage basics also influences other aspects of mortgage application, such as credit evaluation and financial readiness. A solid grasp of mortgage types and terms enables applicants to better assess their creditworthiness and budget appropriately for associated costs, enhancing their overall readiness for successful mortgage approval. By demystifying mortgage basics, applicants can approach the mortgage application process with confidence, reducing the likelihood of errors and enhancing their chances of securing favorable terms. Assessing your financial health is a critical step when applying for a mortgage, as it provides a clear picture of your readiness to take on such a significant financial commitment. Two key components of financial health are your credit score and debt-to-income ratio. A credit score is a numerical representation of your creditworthiness, derived from your credit history. It ranges from 300 to 850, with higher scores indicating better creditworthiness. Lenders use this score to assess the risk of lending to you. The better your score, the more likely you are to secure a mortgage with favorable terms. The debt-to-income ratio, DTI, on the other hand, measures your monthly debt obligations against your gross monthly income. It's expressed as a percentage, and a lower DTI indicates a more manageable debt load relative to your income, making you a more attractive candidate to lenders. Understanding these concepts is crucial in avoiding common pitfalls when applying for a mortgage. A strong credit score and a low DTI can lead to better mortgage rates, saving you money over the life of the loan. For example, a borrower with a high credit score might qualify for a lower interest rate, potentially saving thousands of dollars in interest payments. Similarly, having a low DTI could mean qualifying for a larger loan amount, making it easier to purchase your desired home. Experts agree on the importance of maintaining a good credit score and manageable DTI. Financial advisors often recommend strategies like paying down existing debt, avoiding new credit inquiries, and ensuring timely bill payments to boost your credit score and improve your DTI. However, challenges exist, such as the time required to improve these financial metrics, which can be a hurdle for those needing quick access to home financing. Alternative viewpoints suggest that overemphasizing credit scores and DTI might overlook other critical factors, such as savings and employment stability. Some argue that these financial metrics do not fully capture a borrower's ability to make consistent mortgage payments. Additionally, the emphasis on credit scores can be controversial due to potential inaccuracies in credit reporting. Ultimately, assessing financial health through credit scores and DTI not only influences your mortgage eligibility, but also impacts how you handle homeownership expenses. It is interconnected with other aspects of mortgage application, such as choosing the right lender or loan product. By addressing these key financial indicators, you lay a solid foundation for a successful mortgage application and future financial stability. When applying for a mortgage, understanding and avoiding hidden costs, such as fees and additional expenses, is crucial. These hidden costs can significantly increase the overall amount you pay and impact your financial stability. Hidden costs typically refer to expenses not immediately apparent or outlined in the initial mortgage offer. They can include application fees, appraisal fees, origination fees, private mortgage insurance, PMI, and various closing costs. These additional charges can accumulate, often catching applicants off guard if they are not well prepared or informed. The importance of being aware of these hidden costs cannot be overstated. A clear understanding of these expenses ensures you are not overwhelmed financially and helps maintain trust in the lender-borrower relationship. By preparing for these costs, you reduce the risk of unexpected financial burdens that could jeopardize your ability to keep up with mortgage payments, thereby safeguarding your credit score and overall financial health. For example, consider the case of Jane, a first-time home buyer who was initially thrilled with her low-interest mortgage offer. However, she was shocked to discover additional fees totaling thousands of dollars at closing. Had Jane been aware of these fees up front, she could have budgeted accordingly or negotiated some of the costs. Another example is the requirement of PMI for those who cannot make a 20% down payment. PMI protects the lender but can add hundreds of dollars to monthly mortgage payments, an expense that should be considered when budgeting for a home. Experts in the real estate industry often emphasize the importance of requesting a loan estimate early in the process, which can provide a clearer picture of anticipated fees and expenses. Understanding your loan estimate and comparing it with the closing disclosure helps ensure that no unexpected costs arise at signing. However, challenges arise due to the complexity and variation in fees from one lender to another, which can make it difficult for borrowers to compare offers accurately. Some lenders might offer lower interest rates, but compensate through higher fees, creating a seemingly attractive deal that is actually more costly. This point connects to other aspects of the main topic by highlighting the need for thorough research and comparison of mortgage offers. It stresses the importance of financial literacy when assessing loans and reinforces the idea that borrowers must be vigilant and proactive throughout the mortgage application process. By doing so, applicants can better avoid common pitfalls and ensure a more transparent and manageable mortgage experience. Share, like, and subscribe for more real estate tips.